It all comes back to money.
This is the Keeping Your Money Show with Jamie Westenbarger and Bart Steindler.
All right, welcome back to the Keeping Your Money Show. Jamie Westenbarger joined, as always, by Bart Steindler. We were talking about not getting caught up in the big names of investing and making sure that you don't get complacent, get comfortable, verifying that your performance is what it should be, not that you're just with a name that you've become accustomed to being with. We also discussed potential harm that can come from the fragmented regulation in our industry and how to really be looking for the right person to help you with your financial situation. More credit card companies were cutting benefits. We discussed some of those and what to look for if you rely on utilizing some of those in your credit card situation. If you're not following us on Facebook, I encourage you to do so.
Is that a new dish you had at the Oriental restaurant last night?
I don't know what that was. Facebook.com/keepingyourmoney is where you go. Facebook.com/keepingyourmoney. If you like our page, you'll get updates on what we've got coming up and things that we will be talking about on the show or events we have or anything like that. You can also follow us on Twitter. It's twitter.com/keepingmoney. or /keepingmoney. You can follow us there as well. If you ever want to email the show, you're welcome to do so. info@keepingyourmoney.com. And I do respond to all of those emails personally. The street.com, it's run by Jim Cramer and CNBC. A lot of times they're on there telling you like to buy this stock or sell this stock before the earnings or something. And anyone that listens to the show knows that's not how we do business. We're not stock chasers or stock pickers. I don't have a crystal ball on what company Z is going to say about their earnings this week or anything like that. And, to be honest with you, none of these other people do either. Sometimes I think the earnings projections that some of these wirehouses and stuff put out. I mean, it's really no different than the automated telemarketing call that I get of, pick these 3 winners tonight in the NFL games. They're rolling the dice because they're off so often. And what's amazing is how the market will react to that. They're like, they're going to do $1.50 a share of earnings, and it comes out $1.70, and the market's like, whoa, they're doing so awesome. No. The analyst was just really wrong.
I mean, how can the analyst actually come up with that number unless they're like looking at their books?
Right. And I'm always amazed at how precise it is. It's like they're going to report $1.63 earnings per share. It's like, wow, okay. So, but there was a good article on there, and it's written for the internet. 3 lethal investing mistakes you continue to make. It's probably a little aggressive. I would say 3 investing.
So you make one of these mistakes, you're dead.
Yeah, I don't think that's probably going to happen. But
you think they were taking a little poetic license there?
Yeah, a little bit.
A little exaggerating.
But I think there were 3 points that if you're someone who does purchase individual stocks, which I am neither recommending nor saying you shouldn't. I'm just saying if you do. There's some good points in here about what to look at, because I see clients of ours and even people who come in to get a free, consultation or a second opinion sometimes make these, and the first one is putting full faith in management. And I see this 2 different ways. The first way is it's the company you work for and you swear it's the greatest company in the world. You hear all the time how awesome they are at work, and you just don't know why you would invest in anything else,
Right. You really know them.
Right.
I mean, you've worked there. You really know these people. They are quality. They are smart, But all the companies that are out there that you haven't worked at, there's a possibility they may have some smart people and good people working there also.
Right. And the other side of that is, it's a company you become enamored with for one reason or another. Many people, a full example of this could be, Apple. Not that I'm saying anything good or bad about Apple, just as an example. But you have an Apple Watch, you have an Apple phone, you have a MacBook. You think Apple is amazing. It's the most amazing technology company ever to, be on the face of the earth, in your opinion.
And there are a lot of people who buy their products that really,
Sure.
are almost evangelical about that company.
Which, from a buying their product standpoint, knock yourself out. But when you become an investor, you have to cross over from the consumer side of things and look at it with a skeptical eye. You have to look at what is the growth aspects of the prospects of the company. What are the new product? You have to dig into it. You can't just simply do I love their products, therefore I love the company and the stock. I think we see this with a lot of companies that regularly report losses, but yet their stock continues to rise because people are waiting for that day when they no longer, post a loss. Now, that works for some companies. We've seen companies in the past where eventually they take off. Some companies never take off.
Yeah.
Don't get enamored because the CEO is a really good public speaker and he's kind of quirky and cool, and that makes you want to, own it. Own it because it's worth owning.
Or the product is really cool.
Right.
But they have problems, other things related to the product are problematic.
Sure, the DeLorean was a really cool car.
Yeah.
It was not very successful, though.
No.
Thinking a company has no competitors. This article points out companies like Amazon and Walmart that in their own respects and time have been considered kind of like untouchable, right? They're just dominating a market category. But remember, 20 years ago, there was no Amazon. It came out of nowhere too, so there are always innovators and entrepreneurs out there trying to come up with a way to take that company, off the mark. And a perfect example of that is, while we sit there and we talk about how big of a monster Walmart is, there are other stores like Woolworth that don't even exist anymore. And 40 years ago, they were a monster. JCPenney's on life support. 40 years ago, they were a monster. So just because
Sears is another one.
Yeah, just because someone dominates a category today doesn't mean it's a foolproof investment for you to put your money in forever.
Right.
And then being obsessed with stock buybacks, we've seen with low interest rates, companies have done something probably more aggressively than we've seen in a long time. I think since I've at least been aware and involved in markets, I haven't quite seen it, but it's the stock buyback. They're able to borrow money at such a low cost. It's leaving them the opportunity to buy back stock, or in many instances, they have a lot of cash. They don't want to invest it somewhere else or purchase something else, so they're buying back shares. It raises the price of the stock, which if you're looking at it from a standpoint of, wow, this stock's up 30% this year, make sure you understand why is it up 30%. Was there a stock buyback that caused, now a much lesser amount of shares to be available? That can have a huge impact, and the performance looks great on paper, but isn't really realistic to what the company is doing. Stock buybacks offer zero long-term value to the company. They're not reinvesting in anything the company does. They're simply taking shares off the street and creating less supply, which causes the price to go up.
Right. And they may be thinking that given the cash that they have, and they look at all the investment opportunities that are out there for them, that they may think that buying their own stock is the best of those different opportunities. And it may turn out positive for them. So once again, it's really important to understand that when we're making these comments, these were not endorsements to buy or not to buy a certain stock.
Nope.
Or not to take a look at these things as part of your evaluation. Just don't make one of these things a majority of your evaluation.
Right, or the solo reason of your evaluation.
Right.
Yep, absolutely. All right, coming up, we're going to wrap up the show, send you into the weekend right here on the Keeping Your Money Show.
It's never too late to plan for your future, and the Keeping Your Money Show can help. Our team of advisors can answer questions you may have about investing your money. Through Securities America Inc., our advisors offer a diversified and comprehensive list of quality products and services. Call the Keeping Your Money Show at 1-888-98-MONEY or visit keepingyourmoney.com to schedule your free consultation. You're listening to the Keeping Your Money Show with Jamie Westenbarger and Bart Steinler.
All right, welcome back to the Keeping Your Money Show. Jamie Westenbarger, joined as always by Bart Steinler. Another show in the books. If you're just tuning in, you're waiting for the next show, and you're like, who are these guys? That's how a lot of people find us, They're on one of our stations like BBL, where they're waiting to hear somebody talk about how terrible the Lions are going to be this year, and whether Matt Stafford should be in the Hall of Fame even though he hasn't won any important games. And and then all of a sudden we're talking about money, and they're like, where did this come from?
I was listening to that debate on The Huge Show on my way home one day this week. That was pretty interesting.
It is. We could do a whole show on that. I mean,
yeah.
I could talk about Matt Stafford and the Detroit Lions all day long, but this is the Keeping Your Money show. Come back an hour earlier. Check us out. We talk about all the things that matter to your retirement. We get rid of all the bulls, the booyahs, the bells, whistles, honks, and horns, and give you the information that actually helps you move closer to retirement. If you missed any part of the show, you can find it on our website. Just go to keepingyourmoney.com. You can also find it on iTunes, Google Play Music, SoundCloud, YouTube, and Stitcher. Just search the Keeping Your Money show. If you'd like a second opinion or maybe you need a first opinion, give us a call at 888-986-6639. We'd love to sit down with you and go over some ways that we can help you set yourself up better for the long haul. We talked about being exposed to potentially harmful financial products because of fragmented regulation, credit card benefits that are going away. Do you know if your credit card's affected? We discussed what was going on there. We also talked about the idea of getting enamored with whether it be a manager of a fund or a stock or the CEO of a stock, or maybe it was just the name of a company that you have been with for a long time, and how that could potentially be very harmful to your overall portfolio. And then 3 investing mistakes that you may be making that could be very dangerous to your overall performance. So I'm going to tell you, like I tell you every week, you never go on vacation, you never go on a trip without putting some kind of planning in it. Nobody ever shows up at a cruise ship and hopes to just get on and take a sail. And if you show up at the airport and hope to buy an airplane ticket, I think we can all agree it's going to cost a whole heck of a lot more than if you had done it a little bit earlier ahead of time. And quite frankly, retirement's the same way. We think about retirement as like this destination. We hit 65 and yes, we made it. But in reality, it's just the beginning of another 25, 30 year long trip that you have to have planned properly, or it may not end up the way that you thought. If you do not have a roadmap for your retirement, if you don't have a strategy of how you're going to remove income from all of the money you've saved, then you're in danger of it not going well, and we'd love to help you. Give us a call at 888-98-MONEY and let one of our financial advisor, professional people sit down with you and help you figure out the best way to move forward with planning for your retirement, or maybe you're about to retire, and help you figure out how you're going to draw income out for the rest of your life. For everybody here at the Keeping Your Money show, Shannon Simon, Dan Van Single, Shane Thorson, Nate Boonster, Grant Hall, Troy Fox on the Lake Shore, and of course, my compadre, Mr. Bart Steinler, and never to forget our amazing producer, Laura Ridenour. I'm Jamie Westerbarger. This is Keeping Your Money show. Have a fantastic weekend. We'll talk to you next week.
Registered representatives offer securities through Securities America, Inc., member FINRA SIPC. Financial advisors offer advisory services through Securities America Advisors, Inc. Forest Hills Financial, Inc. and Securities America are separate entities.